Welcome back to Capital Connection. Well, David Costa is Dean at Robert Kennedy College and is standing by to talk to us over there in Zurich. David, thanks for coming in. Let's talk about the expectation in the market for rate hikes then, because you think that, well, many people believe that the ECB will hike before the Fed. That seems to be baked into what the market is expecting. But does that really act as a big driver at the moment when actually people are very focused on the Middle East and North Africa and tensions there? And those two different factors could pull markets and foreign exchange markets in different directions.
Absolutely. Very good morning to you, Anna. I think that the expectation, which we already seen yesterday on the markets, that the euro is going higher against the dollars because of this expected interest rate hike, will certainly have an impact on the euro. And that's getting closer to the summit, which will happen in March, where, again, Germany and other countries want to reinforce the idea of a very competitive Europe. I think that, and a very competitive Europe cannot occur without a competitive euro. I think that a rate hike will occur sooner than expected, perhaps, and that will drive the euro higher.
David, what do you make of this wave of upheaval that we've seen across the Middle East and North Africa that is now having a serious impact on the price of oil, and what impact could that have on the global economic recovery?
Well, first of all, I think that what is happening is particularly concerning because that brings back to the market fear and uncertainty, which doesn't really necessarily stay confined in particular sectors, but can spread throughout every equity, essentially. In terms of recovery, I think that oil has the danger to go higher from here, and the consumer, particularly in the United States, is very sensitive at the moment. So an increase on commodities, which, by the way, is also part of the cause for the unrest in many of those countries, particularly in agricultural commodity, can intensify the problems and could have an impact on the recovery, which is at the moment in a pretty fragile state if commodities keep rising at that pace.
Yeah, absolutely, David. A lot of pain for consumers pretty much the world over. This is Chloe. What is interesting, though, is that even as oil spikes higher, you know that in recent sessions, copper, tin, a lot of these base metals have been selling down. In fact, comments from Codelco, the top copper producer in the world, saying higher oil prices actually bad. What is he trying to say? A lot of analysts disagree.
Well, first of all, I don't think it's particularly surprising from my point of view, because if you follow carefully commodity index, etc., you could certainly see that energy didn't move very much as opposed to basic metals and agriculture in the past 12 months. So it is expected that some of the profits are going to be taken off now in other commodities, and perhaps switching out on the speculation level from some of the agricultural commodities which had already an incredible upside, like cotton, coffee and cocoa, and moving now back into the energy sector. So I think that's pretty much part of the rotation which happens, and much depends on how the situation develops, if that has space to move further ahead. And the real danger here is really that the resolution will take longer than expected, and that will make some momentum on the oil markets.
David, as we've come out of the most recent credit crisis, it seems that perhaps one of the surprising discoveries for investors has been the safe haven status of big corporates with big cash piles and balance sheets, and they continue to pay dividends, and people have done quite well out of them. Which safe haven do you think we should be in now? Because we were surprised, perhaps, by the resilience of some of those big equity plays during the past crisis.
Well, now it is a bit of a difficult moment in terms of some of those big names are involved in staples, and staples might as well be under pressure through the commodities increase at the moment. So in terms of safe havens now, I would say we have seen now the Swiss francs eating higher to the dollars. I think that many of the Swiss-based equities provide, also or the Swiss multinational, provide with a pretty much good safe haven status. On the other hand, I still think that consumer staples are a good safe haven as opposed to the rest of the market. And this particular uncertainty might create opportunities where some of those big names are dropping in value, but they're still a good buy at the moment. So opportunistic investors might have a good market with this volatility.
Which are the big dividend players, David, that you're looking at then? Because, of course, we've got BASF earnings out today, and the talk around that stock is that they'll return to paying some sort of industry-beating dividend yield. Which kind of companies are you looking at?
Well, the BASF is perhaps one of the most interesting one at the moment. Really across the board in Europe, I see quality companies. I'm looking at companies not only with a high dividend, but also with a sustainable business model, which have perhaps a lot of exports. So I'm looking certainly at German companies as a very good opportunity. But even in the Swiss market, we have surprisingly many companies paying a very good dividend. Even Swiss regional banks, with a pretty much isolated outlook from the rest, are among my favorites at the moment.
David, thank you very much for coming in. David Costa, Dean at Robert Kennedy College, joining us there from Zurich. Let's have a look at the opening calls then.